Welcome, everyone. We're very excited today that you're joining us for another installment of the Duke FinTech Coffee and Crypto. Today is March 15th, 2022. And when we have a very special guest today. First off, I want to introduce our regular hosts. We have Dr. Jimmie Lenz and Lee Reiners, both from Duke University. I'm going to hand it off to Jimmie and to Lee to introduce themselves as we get started.
Perfect. Thanks very much, Elizabeth. Always nice to be able to speak with Lee, and when we have a special guest, even better. This is me. A lot of you have tuned in here before and are familiar with Coffee and Crypto. I run two of the graduate programs at the engineering school at Duke, the Master of Engineering in Financial Technology and the Master of Engineering in Cybersecurity. I come from about 25 years in finance in a number of different roles. And I'm going to hand it over to Lee to introduce himself, and then we're going to throw it to our guest this morning. So, Lee.
Well, good morning, Jimmie, and good morning, Sultan. Good to see you. So I think, we have mostly repeat viewers here, so I'll spare the long bio, but I am Lee Reiners. I'm the Executive Director of the Global Financial Markets Center at Duke Law School, where I teach courses on FinTech Law and Policy, Crypto Law and Policy. I write and speak frequently about FinTech and crypto issues. And I briefly want to do a plug, and I know we'll plug Sultan's talk later today, Jimmie, but also later today at 4:30 at the law school, we are hosting the SEC's Regional Atlanta office for a presentation on the life cycle of an enforcement case. So if you want to learn more about what the SEC does and how they bring in enforcement action from start to finish. And trust me, this is something that a lot of folks in crypto could benefit from. Okay, be sure to check that out. I just put the event posting there in the chat. So with that, I will turn it back to you, Jimmie.
Perfect. Hey, thanks, Lee. It's always nice for you to be able to host some different people coming on campus. With that, I want to introduce our guest this morning. Lee and I are always talking about different aspects of crypto and what's going on in the world. And when we think about what's going on in the world and we think about the large regulatory agencies and things like that, one of the agencies that comes through loud and clear is the FDIC, and they largest insurer in the world, banks. They hold a very special place, in particular in the United States, but in the global financial system too. And so we're lucky enough this morning to have the very recent head of innovation, Sultan Meghji, with us. He penned an op-ed a couple of weeks ago that got a little bit of attention, and he was talking about why he left the FDIC as the head of innovation. I can't really do justice to his bio, so I'm going to let him do it himself. And so with that, Sultan, the floor is yours.
Well, thank you so much, Jimmie and Lee, for having me. It's always nice to do stuff with Duke. I feel like I just am kind of keep orbiting Duke slightly closer and closer every time. I've done some guest lecturing here already this semester. But yeah, from a background perspective, I'll say it like this: next month I celebrate the 30th anniversary of my first NSF grant focused on artificial intelligence, basically building a lip-reading supercomputer. And then spent a lot of time in the 90s doing a lot of foundational technology work for the plumbing of the internet, if you will. Then went corporate and worked at places like the New York Stock Exchange and others. Then moved over into the startup universe, worked in cloud computing and biotech and fintech, have been a adjunct or professor of practice for the better part of a decade now. And as I like to say, before I took the job at FDIC, I was going to retire. And now I'm going to jokingly say that I'm retiring again and just doing my scholarship at the Carnegie Endowment, doing policy on digital assets and climate at the Brent Woods group, and then teaching. So I have very little going on now. It's great. I love it.
No, it's great to have you. So with that, I'm just going to jump right in because I mean, there's so much going on since Lee and I last talked. There have been, 1,000 things that have happened in the world in particular. And so probably one of the biggest things in crypto just happened about a week ago, and that's the executive order that came down. Sultan, I know that you had probably maybe a little bit of a hand in that before you left. So I'd like to get, both your opinion and Lee's on not so much the executive order, but kind of what you see as the pros and cons and, where it leads us in the crypto space going forward. Sultan, if you want to go first.
Well, okay, I mean, I have a lot of opinions about the executive order, which is authored by a lot of people much smarter than me. I'll declare that up front. The most interesting thing I think about the executive order that I really hope people pay attention to is that it's an executive order. It's not an act of Congress. It doesn't change the law. It doesn't change the statutory authorities of agencies. And it's not meant to. Right. It is a statement of intent. It's a signal. It's an attempt at an emotional true north in a lot of ways to say, hey, listen, we need a unified national policy on this, which I agree with completely. We need to aim ourselves in a certain kind of direction. But it also very clearly says that without congressional action, there are going to be big gaps. And, one of the more interesting discussions that I got to hear over the last time when I was at FDIC was a philosophical differential between two different opinions. One opinion was that the existing regulatory regimes will work for crypto, which they may or may not. There's some cases where they will. I think there are other cases where they won't. And another group of people who feel like we need new regulatory structures that are more modern, that come from an understanding of these technologies. And that actually led to one of the points I made that I've made very strongly since I left is that the vast majority of people that are involved in these kinds of decisions, especially at the federal regulatory level, don't have STEM backgrounds. They don't have any applied experience in any of the businesses or technologies that they're talking about. I used a phrase something like analog people making digital decisions. And to me, that's a huge challenge that we have right now, and it's hurting our competitiveness globally. It's hurting the innovation ecosystem here, and I fundamentally think that it's creating less safety and soundness in the financial system.
I think that's an interesting point in that what this is supposed to do at the end of the day versus what what the results may actually be. Lee, I know you probably have some thoughts about this.
Yeah, I certainly made the media rounds last week. I feel like, including another appearance on CNBC with the Mooch, Anthony Scaramucci. I agree with parts of what Sultan said and disagree with others. Certainly agree on the point that this is not legislation, right? So there are a couple of ways to think about this. I tend to think about it from a practical standpoint in terms of what's going to change, right? What is changing when it comes to digital asset crypto regulation? And the answer is very little. The status quo is going to prevail for the time being. And I think that's a win for the crypto sector, actually. And, I think the crypto sector is interpreting that as a win. I mean, you saw the day the order came out, Bitcoin shot up by, 8%, ETH was up by 5%, and the very next day it reversed itself in true crypto fashion, right? But, it's an asset that trades on sentiment. And so the sentiment was very positive because the narrative leading up to that was that the Biden administration was set to crack down on crypto. This is something that you kind of kept hearing frequently. I think this view was sort of informed by, the SEC's approach to digital assets. And this executive order is anything but a crackdown, right? In fact, I think it's a complete 180 because it's an acknowledgement that crypto is here to stay, one. And then two, not only is it here to stay, but it says the executive order says that the U.S. should lead on digital assets, that it's important to lead in order to retain our status as, the financial capital of the world, right? And so it's very much viewed through this national strategy.
Oh yeah.
So I think that sentiment was also very, very, very positive for crypto. Now, one of the things you've heard for a while from folks in the crypto sector is that we need a national strategy when it comes to crypto, right, or digital assets. I don't think this constitutes a national strategy, right? I don't. It doesn't really, frame kind of what is our goal here. If I had to characterize it, I would say it's saying let's harness the benefits of digital assets while controlling for the risk, right? But presumably that's the attitude you would want with any type of innovation, right? So that's not necessarily specific to crypto. And me, Jimmie, I would actually push back on the premise that there are any benefits worth harnessing, right? I know it's not a popular opinion here, but I'm on the record in other contexts that the costs outweigh the benefits here. And so I would have liked to see, if this is how the White House feels, I would have liked to see them kind of state up front, some of the potential benefits that they see. And you've seen that in other contexts. So for instance, the President's Working Group stablecoin report, very upfront says, this is how we see some potential benefits here for stablecoins when it comes to payments, financial inclusion. So the executive order kind of hints at some potential benefits around financial inclusion, maintaining the dollar status as the world's reserve currency, but it doesn't really detail them in any meaningful way. And so what happens next? Well, I haven't counted them all up, but there's probably at least 8 reports that the executive order calls for. And these reports are going to be produced by, essentially every agency of the federal government, not just the banking regulators, but the Commerce Department, the Defense Department, right? The National Security agencies, the National Science Foundation. So everyone is going to get a chance to kind of weigh in here on digital assets. And when you look at these reports, it creates sort of new vectors for lobbying to take place, right? So kind of, this is where the revolving door spins into high gear here, right? And the lobbyists get, earn their keep, because now we have new pressure points to try to influence the outcome here. So I think this is another example of just kicking the can down the road when it comes to digital assets. And like I said, the status quo is going to prevail here.
I don't, I have to say though, I don't, you can't regulate innovation, and you don't see. I've never seen anything terribly innovative come out of regulatory agencies. So looking at regulatory agencies to manage an emerging technology, that's never going to work. I've never seen it work in the past. It won't work this time. And this is an emerging technology. It's, the idea of cryptocurrencies, and, obviously crypto assets are more than just cryptocurrencies, right? As you said, stable coins and central bank digital currencies, NFTs, things like that. So there's a fairly broad spectrum. But trying to look to the federal government to regulate this innovation, if you want to squash it really quick and drive it away, that would be the quickest way to do it, in my opinion. I don't know, Sultan, what do you think? I mean, you've been there. You just left there.
Oh man, talk about lobbing it up for me. So actually, I'm going to go back a little bit. Lee said a couple of things that I think are really important to not only cheerlead, but also double click on. The first is this can kicking down the road comment that he ended with, which I think is absolutely correct. I don't care. And having talked to the vast majority of the agencies that have to write these reports since the EO came out, and we have continuing conversations with them, it's clear that you're looking at an 18-month timeline for anything to get published of any meaningfulness, even if it only takes them 8 weeks or something like that. I notice a few lawyers from my old life sitting on this call right now, and I'm sure if they were to jump on, they would smile and nod and knowingly agree. But the fact is, you're looking at 18 months for a bunch of research reports that are going to say nothing incredibly, I would say, surprising in a lot of ways. And at the end of that 18 months, you're going to be exactly back where you started. Maybe there's a little more knowledge of these technologies and the use cases around them in some of these agencies, but Most likely not. I think in a lot of ways, this is designed to get the bureaucratic leaderships at a lot of these agencies kind of up to speed a little bit better so that they can start answering these questions. So that's the first thing. The second is, we as a nation are kind of bad at national strategy right now, especially when it comes to the regulatory space. Regulatory agencies, I don't think historically have a great track record of being proactive. It was one of the reasons I joined, is I really wanted to see if we could, get proactive about some stuff. And I got to tell you, I was 30 pounds lighter and had a full head of hair before I started. Joking, I didn't, but like that's certainly how I felt. And the fact of the matter is, regulatory agencies respond to crisis. And I think one of the pieces sitting behind this activity is that people are worried there's going to be a crisis. We have about 2 trillion in digital assets right now. Roughly speaking, 60 million Americans have digital asset wallets, of some kind. You're looking at a massive unregulated space. And I think there are a lot of people in the regulatory system who are nervous about that. I think from a consumer protection perspective, there's a huge amount of concern that I think is in many cases quite justified. And so they're in a new space, right? These are reactive people who are not technical, seeing something that they need to get proactive about that is highly technical, and they're trying to kind of get in front of it. And it's a new muscle for them. So I have a lot of sympathy for the next few years.
Sultan, do you actually think it's consumer protection, or do you think it's protection of all of the legacy institutions that are lobbying like all hell to put some kind of controls over something that, they can't participate in, and they see how much you said, you mentioned $2 trillion, but if you count all of the stuff going on in DeFi and all the leverage, it's closer to 4 trillion, or we're approaching 4 trillion.
Yeah, right.
And so there's a lot of assets. There's a lot of things that are going on. And a lot of these are not, you hear the stories around kind of some of the really out there type things, but a lot of this are basically savings accounts. They're like CDs that people are buying. When you hear about yield farming and things like that, essentially it's a CD. You're locking money up for some period of time, or, maybe a hypothecation of securities. This is not like some, really, really out there complex derivative or anything like that.
Yeah.
So my question, and Lee and I have talked about this a little bit before, is how much of what the regulatory agencies are doing is just protecting the people that are banging on their doors with lobbyists versus truly consumer protection?
Well, I mean, the way I muddled my sentence, I hoped it wasn't clear if I said consumer protection or protectionist. And I think that kind of gets to the exact comment you're making, right? And in some cases, it's proactive, and I met a lot of people who fundamentally say, the US dollar should only be held by banks, and they want to shut down anything that isn't a bank. I mean, I've heard people in my previous life, both at the old agency I worked for and others, say things like that. And it's, that's fine. I mean, I would say though that, the minute somebody comes up with a DeFi'd digital asset savings product that had some degree of insurance that would mirror functionally an FDIC insurance, the minute that comes out, that actually garners interest, which 99% of bank accounts really don't do anymore, because most banks are highly inefficient operations. They make their 7% arbitrage, but most consumers don't see a penny of that, right? And in many cases, especially for the poorest amongst us, they actually have to pay extra money just to have the benefits of having that insurance, then it goes right to the coffers of the bank. And we talk about overdraft fees and all this other stuff, right? The minute somebody offers something like that offers a 4 or a 5% with a reasonable insurance structure around it, I think we're going to see a radical shift in where consumer deposits go. The fact is, nobody's offered that product yet, and one of the reasons is because of this kind of behavior. One thing that I'll tangent slightly, that I'll mention, that I don't think a lot of people realize is, when you have a bank account and you want to, do your direct deposit or, whatever, get an electronic transfer. In many cases, you're using what's called an ABA routing number. And I'm sure we all know that, your ABA routing number in your bank account, that's how you get your check deposit. Well, the ABA, you would think that's a core piece of the banking infrastructure, right? You would think that that's, governed or regulated or run by the US government in some way. It's not. It's run by a private trade association in DC, whose CEO makes, $4 million a year or something crazy like that, and they have tremendous control. So your comment about lobbyists is an important one, because they own parts of this infrastructure. And so that's why so much of this interesting payments activity is getting so much negative attention across the board, whether it's from the existing banking providers or the regulatory agencies or the politicians and lobbying infrastructure. The other thing that I would add is, we're at a moment where generationally, lots of people question systems. They question the infrastructure that are around us because they see it has not been adding as much value to them as it has for others. And they see disequities, they see discrimination, they see, oligarchs making all sorts of money and they're struggling to get to $15 an hour, right?
I think you bring up, you bring up a great point about that. But I want to go backwards for just one second, because I want to ask Lee something you brought up, this idea of an insurance fund for digital assets. That's a really unique concept, but not really, because every bank account buys in. It's the insurance company that used to work for the FDIC. Brokerage firms through the SIPC do something very, very similar. Credit unions have, a similar sort of scheme that mutualizes the risk across, all of the participants. Lee, what's your thought about having some kind of an insurance type of mutual insurance group that would protect digital assets?
Well, personally, if I could get 4% on a savings account that was insured, I would say hallelujah. I would freaking love it, right? I think everyone would love it. Yeah. But you have to ask yourself, how would you get there? I mean, the reality is that that insurance could only be provided by the federal government. I mean, if it was mutualized, there's just no way that they could be able to charge, give you 4%. Given the cost probably. Now, we're heading into this rising rate environment and inflation, so who the heck knows what the future has in store. But historically, this notion of deposit insurance is critical. It informs our approach to bank supervision, because banks are effectively extensions of the sovereign, right? Because they fulfill a public policy function. They're critical to not only keeping people's money safe, but to commerce, right? They make loans. And because they're given certain privileges, for instance, you have to have a bank charter. Like you can't just open a bank, because you feel like it. You're given a charter by the government. It could be either the state or the federal government. And then that charter gives you, access to things that only banks have. So FDIC insured deposits, right? And that's the cheapest, source of funding there is. Yes, they have to pay, but the reality is, especially for the largest banks, is that benefit vastly outweighs the deposit premium. So no one else can take deposits, and like we just talked about, you get, it's a cheap liability, right? How much are we getting paid for our savings account? So that theory kind of banks as extensions of the sovereign, or the franchise theory of banking, really informs a lot of our approach to supervision. Now, does that mean that everything has to be a bank? I think this is the debate we're having right now within, the crypto world. And of course, when you're a prudential regulator, you want to bring everything into the prudential fold, right? And this is kind of the issue with stable coins, right? Is, the President's Working Group report, their main recommendation was to bring stablecoin issuers into the banking system, require them to become FDIC insured banks. Now, is that the right approach? I don't know. I mean, that's debatable. But this gets to, back to kind of Sultan's point, where, when you have regulators make strategy, they're going to want to regulate it, as they regulate other, the things that they have traditionally. But one of the interesting things about this executive order was, and there's many, is this central bank digital currency notion. I was pretty surprised at how bullish the EO was on this idea of a central bank digital currency. And back to both Jimmie and Sultan's point, it's telling that the banking lobby kind of pushed back pretty aggressively right away on this idea. I think you saw both the Bank Policy Institute and the American Bankers Association say, well, geez, we don't need a CBDC. Now, of course, they're worried that this will, take deposits from the banks, right? Because, why would I, have my money at a bank when I can have liability in the federal government that I know Is
Right.
risk,
Yeah, I mean, Lee, let me jump in on that. I think there are a couple of concerns from the existing banking infrastructure around this, and you highlighted one, but I think until the Fed actually makes a declarative statement about which use cases a potential CDBC may or may not do, I wouldn't jump to there's going to be the equivalent of all of us having CDBC wallets equivalent to Fed master accounts. Like that's pretty far afield, right? And second is, the Fed just put their first paper out, and it was a pretty, entry level, kind of initial paper. I'm sure most people here have read it. It's totally worth reading because you do kind of understand kind of where their thinking is on this discussion. The fact is, just by starting this discussion, I think it's interesting, but let's be realistic about the timeline for them to even define the use cases where, there'll probably be another president in the White House before the Federal Reserve makes a declaration about which use cases they're even seriously exploring, right? I mean, this is not a 12-month, 18-month conversation. Project Hamilton was awesome in terms of the speed with which it built some actually very interesting technology, but that's a prototype. And they were really just trying to say, can we get the transactional volume needed to support a wholesale function, not a retail function, right? Yeah. And 6 months from now, 12 months from now, we'll start to get a better sense, I think, of how some of these things will lay out. But, I think there's actually a second reason why there was pushback on the CDBC, and that was because the CDBC implies that you have a modern technology stack that is a real-time banking core that can actually do, the equivalent of real-time reconciliation. You don't have to do batch processing. You're using modern payments infrastructure. It uses modern cybersecurity. And I jokingly say that I can, count on, with my two hands and probably not even use one of my two hands, the number of banks that actually run an infrastructure like that in the United States today. And that is a significant concern for me.
And I think that's a great point, because when you start looking at those kinds of things, efficiency in the banking system is not something that they crave. One, they don't want to put the investment into it. But secondly, I mean, if you had a real-time banking system in the United States, that eliminates overdraft fees immediately. What were overdraft fees last year? $20 billion? I mean, it eliminates all those kinds of things immediately. What would happen if we had a central bank digital currency and all of a sudden we could, give them up, if we're going to do, any kind of payments, Social Security payments, anything like that, could be just put in your wallet, no checks being mailed. It would make things so much more efficient. But by making things, that much more efficient, of course, it takes a lot of fees out of the system that banks are collecting now. And, to your point, Lee, about, making 4%, oh, I'd love to make 4%. Mortgages this morning, 30-year mortgages are at 4.5%, and you're earning what, 2 basis points at your bank? I mean, it's freaking criminal. It really is.
Well, I think we'll wait for the Department of Justice to make a declaration on the criminal side of it. But but the fact is we have a banking system that really is architected pre most of the technologies we're talking about, right? And the vast majority of organizations out there are operating fundamentally like they were in the 1980s. There's not a lot of difference there, right?
No, I totally agree with that. And the crypto sector and like fintech in general, they're very keen on pointing out very real problems with the banking sector, and we've addressed some of those today. The US has a slow and antiquated payment system. Like it's just not right, frankly, given, what you see in Asia, in Europe, and that disproportionately impacts the poor. The reality is that it's expensive to be poor in this country. And so things need to change. And I'm actually agnostic in terms of whether a CBDC is the right tool, right, to bring about that change, right? And I think, again, we get so fixated on the object, right, whether it be, stable coins or CBDC or, or Bitcoin or Ether, and we fail to ask ourselves, well, what is the problem that this object is attempting to solve? And I think in the CBDC case, the problem is, an slow, antiquated payment system, right? We need real-time payments. Now, the Fed is working on a project called Fed Now, and I'm sure Sultan has been, immersed in and can talk more about. I think it's supposed to kick off next year, fully operational in 2024. I mean, that's still too long. But I do wonder if that actually brings about the needed changes, how much of this kind of momentum behind CBDC and digital assets will will go away. But I do recommend that Fed paper on CBDC from, I think it was January or December, because it really laid out the critical policy issues. Sultan's right that it doesn't need to bypass the banking system. In fact, the Fed said that if we were going to do this, we would want an intermediated model, right? So where the consumer is not directly interfacing with the Fed, that the consumer accesses CBDC through the commercial banking system. I think they were agnostic on whether it was tokenized or account-based. This is something that Chris Giancarlo of the Digital Dollar Project, former CFTC chair, is very keen on, a tokenized model of the digital dollar, which would be a digital bearer instrument. So there are a number of different policy considerations that need to be made, and those should be made by our elected representatives, right? Because they impact all of us, right? And the Fed, to their credit, acknowledges that. So Chair Powell said that he wants Congress to give them the authorization. Like, if this is something that people deem worthy, that the authorization needs to come from Congress. The Fed is not going to do this alone. And so it's pretty clear to me, reading between the tea leaves, that this was not something the Fed was keen on kind of pursuing. And that's why I say the tone is different than the executive order, because it's clear when you read the executive order that they view CBDC not just as an opportunity to improve financial inclusion, but as part of national competitiveness. And I think China is hanging over this, right? Digital yuan is is casting a shadow on this for sure. So, and the executive order does say, the Attorney General will have to comment on whether or not the Fed has the legal authority to do this on their own. So, but back to kind of Sultan's initial point on the overall executive order, it calls on Congress to do nothing. It doesn't say anything about Congress, and ultimately that's where real meaningful change is going to have to come from. And one of my frustrations with the EO, there's already plenty of reports. We've talked about some of the reports already. We've talked about the Fed CBDC report. We've talked about the PWG stablecoin report. To me, there was enough there to collect and synthesize a national strategy, whatever that may be. And I think part of that would be to call on Congress to address these regulatory gaps, particularly around the consumer protection issue, because I say this repeatedly, and yet it just doesn't get picked up in DC, is that because crypto is a commodity by and large, Bitcoin, Ether, extension coins that look like them are a commodity. Commodity spot markets aren't regulated, right? Only commodity derivatives markets are regulated. So we have crypto exchanges like Coinbase isn't regulated.
Yeah, but Lee, but you don't have to. But people do this voluntarily. Nobody is saying, oh, you can't. You have to do this. You have to. People voluntarily, and it's not even easy. You have to make a real effort if you want to get involved in cryptocurrency or any kind of crypto asset. It's easy to
open a Coinbase account. Anyone can open a Coinbase account.
It's not simple. It's a heck of a lot easier to go open a Bank of America account than it is a Coinbase account, right?
No, it's the same. It's the exact same.
I think it's much harder, really, because I've never had to show a picture ID and go through all of the stuff. I mean, there's multiple steps, right, to opening a Coinbase account. I think it's a little bit. Gemini account is much harder, right? I think that they've taken great pains to do that. But what I'm saying is, everybody does this very voluntarily. Everybody goes into this. And so, the idea of a national strategy and things like that, I mean, I've never seen anything come out of a national strategy. It's just, would the iPhone that you have on your desk, would that have ever come out of a national strategy? Absolutely not. I think we have to let innovation run its course.
So could I just throw in two quick comments? So first off, to the comment about a national strategy, I will say, in the few weeks I've been out, the most interesting thing is I've probably been equally busy, if not more busy, talking to the federal infrastructure, whether it's in the legislative branch or other parts of the executive branch since I left, about this exact issue, the lack of a national strategy. I've been very fortunate to be spending quite a bit of time with a number of elected representatives. And I think, Lee, to your point about an actual national strategy coming out of Congress with appropriate legislation that looks at the outcomes of this, what are we actually trying to accomplish? I think there is absolutely an appetite for it, and from my perspective, more of an appetite than there ever has been, or at least in the last decade or so. So I think that's one comment that I'd say to hopefully to lower Lee's temperature, 5%, on this one. The second is on innovation, and Jimmie, I hear what you're saying, and I totally get your real point. I come from a world where the DARPAs of the world, the DOEs, the NSFs really did create the plumbing of and so much of the framework and infrastructure that we have built so much innovation on. I think there's more of a collaborative relationship opportunity here than a yes or a no kind of thing. So, for example, do I agree completely that the U.S. government could never build an iPhone? Yeah, 100%. I mean, my comment, hearing you talk about FedNow is fantastic. How long has FedNow been in development? We're a decade basically, and in the time since they started working on it, the clearinghouse built RTP. Well, now guess what? RTP is the most dominant money movement infrastructure between banks in the United States, right? It's 80 cents on the dollar or something like that. That's the last time I checked. And so, for me, I think there's tremendous opportunity. And so I look to organizations like NIST, which is doing some absolutely fantastic work on the cybersecurity front. I look into some of the work DHS is doing. There is some absolutely fantastic work. And one of the things that I really tried to do in my previous role, and something that I really do hope more agencies do more directly, and that I hope Congress does more directly, is to engage private sector, public sector, academia, to really collaboratively understand, because everyone has different interests here and different roles in the system, right? We need to get to a point where we are not having entry level 101 level conversations about this while the digital yuan is going 400 miles an hour and is I think might still be the most popular app in the App Store. We need to get to a point where we understand that for the last century, American success economically and socially has been on the back of what has been the most advanced banking system in the world. And we rebuilt the world order with the Marshall Plan and Bretton Woods after World War II, and we created a home for democracy in that economic system. The PRC is doing a heck of a job showing an alternative that has far more value at lower cost, right? So that is a huge discussion point. And so if one comment I have about the EO is kicking can down the road, the other comment is it's trying to boil the ocean, right? It's trying to solve 18 different things, but not actually directing anyone to do any of those 18 things. I read the word encouraging like 13 times, and then I stopped counting, right? We have to think about a national economic strategy, but we also have to think about what's best for the American people. And to me, this kind of progress, not process, is where I'd like to leave my last comment on that. We need to actually see outcomes. And simply having a working group on something, simply spending 8 years thinking about it or writing a bunch of memos about it or whatever, none of that is meaningful. The number of times that I've seen 5-year plans to do something that are designed because the planning horizon of the executive or executives in charge is they know in 2 years they'll be in a different job, so it doesn't matter. And then because it's the federal government, half or more of the staff are going to be retired by the time that is, because it's the oldest workforce out there. And so you have a bunch of people who are very comfortable having a lot of meetings, not very comfortable trying to actually drive pace of outcomes. And also, we have to understand that there are a lot of analog people in the room, and so it's just a perfect storm of activities that cause the executive order maybe to be the best thing that can come out.
Yeah, I mean, that's such a great point. So that on the planning horizon piece, I mean, it's it's one of the, I guess, the downsides of a democratic system, right? China doesn't isn't constrained in that way, so they can take the long view. You see them take the long view on a number of different fronts, and and it's working for them.
I mean, at some point, I feel like we're going to have a pretty serious conversation about the incentivization structures we use for all of us. But that's, not, I think, for this. I don't think we would want to call it coffee and crypto and human capital management. Yeah. I think you'd immediately lose half of the people who show up for these, right?
I know. Well, now we'll create our own DAO with the proper incentive structure. How about that? We'll create a governance token. But
it would be hilarious to see a government approach, independent agencies as DAOs. I would be very intrigued to see that attempt. That would be really interesting.
But you know,
that would be quite interesting to see a DAO exist on that level. I think, in that kind of environment, that'd be remarkable.
But my strategy. So you know, Sultan's point about the U.S. financial system in post World War II, you know, the role it's played is so critical because you're seeing that play out right now, right? Just look at the devastation that we've imposed on the Russian economy by cutting off access to the dollar, right, and to the U.S. financial system. And so, you know, the dollar status as the world reserve currency provides all Americans with tremendous benefits, right? So not only can we use it as an instrument of foreign policy, which we're doing now, but it keeps interest rates lower than they otherwise would have been, right? It you know, it facilitates our debt binge. You know, it makes, you know, international commerce easier, you know, international travel easier. You know, these are things that we take, you know, for granted, but they're you know, we shouldn't. And so if I were to write the EO, I would have started with that. I would have started with, you know, the US dollar as the world's reserve currency is a benefit to all Americans. It is a stated policy of this government not to do anything that would undermine the dollar's status in the world economy. That's your operating principle. And then you go from there. And that doesn't, I think, you know, automatically mean that you say no to crypto, right? Maybe it means you need to future-proof the dollar and embrace a CBDC. Maybe it means you need to, you know, fast-track stable coins and, you know, bring them into the banking system or not, right? But I think that should be the stated goal, is not to give up, you know, what some, you know, economists and Charles de Gaulle's finance minister called our exorbitant privilege, right? Let's not give that up. I think that's one of my critiques of non-sovereign currencies, like, you know, Bitcoin and Ether in general, is that they're undermining the dollar status and, you know, our sovereignty. And I just think it's a huge mistake.
So Lee, I have to give you such props for jumping to global reserve currency. You did it earlier in this conversation, doing it again. To me, I think it's far more meaningful relative than something like a GDP or something like that when you're thinking about the power, the political power dynamics of a currency. So global reserve currency, I'm old enough to remember when it was in the 70s, right? It was 59 last quarter, you know, reading the tea leaves, it's going to be 57 and change, you know, second quarter of this year. And that deceleration is accelerating, and none of the monetary policies we've come out with recently seem to be designed to change that. So, you know, very likely in the first year or two of the next presidential administration, they're going to be, for the first time ever, the U.S. will not be the primary global reserve currency. It will have a plurality, but it won't be the majority. And I think once that happens, there are a bunch of other things that start to happen, right? You know, one of the fun stories out of Bretton Woods is that the only reason the US dollar became the global reserve currency is because the British ambassador to the discussion, I can't remember the guy's name because I'm old, actually left the room because he had to go to the bathroom. And the American guy just wrote in, well, let's just call it the US dollar for now, no big deal. And he wrote it in there, and then they never noticed it. He didn't notice until he was like on the boat back to England that he realized that the US had kind of taken this over. And on the back of this, there was a really fascinating thing, because the US dollar shouldn't have been a global reserve currency at that point. It should have been a separate, and that was the original intent, was for it to be a separate international currency. Now we're in a situation where the US dollar will not be the global reserve currency unless something fairly radical happens. And I don't see that happening. And so the question for me is, in all of these discussions, right, we're spending a lot of time talking about crypto. Okay, great. Crypto is an interesting piece of technology. I think there are tremendous use cases for it, most of them not around currency, frankly. And at the end of this discussion, where are we going to be? Global reserve currency is going to continue to decrease. Massive debt that we have no structure to pay off. High inflation. I mean, you start adding up all these things. You have land war in Europe. You have a Russian economy that is going to create probably the largest humanitarian crisis in our lives, right? Just when you look at the agriculture, food supply, lack of activity around that's happening. So all of a sudden you're going to have tens, if not hundreds of millions of people without food later this year. Here in the US, obviously, we're going to be fairly insulated from that, but I worry about Europe. I worry about, Central Asia. I worry about Africa. We have these huge problems. So, if we can't get some of this simple stuff done, like how do we create paths for less friction, more equitable banking? how do we solve some of these other ones? And so I hate to kind of be a downer on this, but we do have we are spending a lot of time on very small details and not a lot of time, to Lee's point, on national strategies that we fundamentally need to have answers to. And I'm pleased, when I talk to congressmen, senators, whomever, they get it, but it's not happening in Congress. You're not having the kind of thoughtful discussions around this. And so, for me, it's really simple. Will we have a CDBC or something like a CDBC? I'm sure we will. Will it be in 10 years? Probably in 10 years. Right. I'm not talking, I think we need to be realistic about that. And so this gray area from a regulatory perspective is going to continue to exist. And that gray area is both really positive for people who want to innovate in the gray areas, but it's also really negative because it leaves open the opportunity for consumers to be taken advantage of. It leaves open the opportunity for bad behaviors in systems to be created and reinforced. Right. And so I think the EO is great. I wish it would have gone far more into detail. And I wish it would have said, for this agency, here is what we are expecting you to do. A, B, and C.
I want to bring up kind of a little bit different area because I know we've kind of focused a lot on the central bank digital currencies and the like, and that's some of the stable coins that we see being used today. In particular, some of the bank consortiums, and I'm thinking of the one bank consortium that has been kind of organized around some of the companies that are on a little bit of the cutting edge of using different kinds of digital assets to facilitate mortgages and things like that. Companies like Provenance and Figure and the banking consortium that they've put together with their own digital currency. And I see other banks starting to jump onto that. Is this going to be, is the innovation going, is the federal government going to be, kind of dragged, kicking and screaming along as innovation basically sets the tone, and there will be no going backwards? Are you guys, what do you guys think about, kind of those things that are happening right now? That, I mean, this isn't pie in the sky. This isn't a plan. This is banks already doing this.
I'd like to get Sultan's, because this is like what we're used to seeing, Sultan, at the FDIC, right? Because banks have been the last to kind of get into crypto, right? Because they're scared to death of the lack of regulation, of being accused of facilitating money laundering, and they've been seeing all these other companies make money hand over fist, right? So what were they saying to you?
Well, it's really fascinating. The banking system is one of the areas where they've lagged on technology, far more than a lot of others. The digital transformation journey, as we euphemistically call, getting up to speed with cloud over the last 15 years, is something the banking sector has really been slow on, right? So you had that as kind of, step one, right? These guys were kind of lagging on technology, and then all of a sudden they see all this really interesting activity that I think, for right or wrong, they see as, somebody eating the breakfast. And so then they get excited about it, and then they go in. Historically and at a very high level in the US, the banking system, the banking regulatory bodies are reactive. They never approve something. They wait to hear you're doing it. They come in and examine you, and they say all the things that people say, and you go through and you do this and you evaluate, and then you train the banks train the examiners on how to look at the technology, and then the examiners go off and do a cycle or two, and whoever goes first gets, as I think one banker has told me, a proctology exam, to go through and do this, right? And certainly that kind of default reactive behavior is something that is, kind of enmeshed in the regulatory system here in the US, right? It is not proactive. And there's kind of a really reasonable reason for that to be true, right? This kind of prescriptive proactive model that you see, especially in, Europe and Singapore and places like that, is prescriptive, but it does require a very high degree of technical acumen in the regulatory system, which we generally speaking don't quite have. And so it's hard for them to say, yes, you must update your firewall this day, or you must audit your source code in the following way, and stuff like that. Absolutely, there is tremendous pressure from the banks into the regulatory system to say, you figure out how to let us do this, because we're not making money. Right. We see, I've had so many bankers kind of, yell in the way bankers do, not really, but, to say, hey, listen, this guy over here is offering a depository product at this rate with this amazing technology, and he doesn't have to have any of the regulatory burdens I have. You guys should do something about it. The agencies would correctly say, well, we don't have the statutory authority to do that, so we can't, right? And so this is where this is why I have for a very long time said, and will continue to say, this has to come from Congress. You know, the Banking Act, the FDI Act, these are all 80 years old, 90 years old at this point. We really need to start looking at new legislation to reframe this. Now, that is rife with a million different, concerns. And I don't think there's consensus on what a correct program looks like. We obviously even have a fractured central bank. So we won't ever get to a point where it is, it's like with Germany or Singapore, where there's like a single regulatory body, you fill out a single form and, here's prescriptively exactly what you're supposed to do. I think a lot of people who come from more technical backgrounds would be highly comfortable with that. But I know the regulatory system itself is not comfortable with that. And so, but I come back to the point I made a minute ago, this regulatory gray area we're going to be in for a while, is going to both be negative for the banks because they won't have a clear path to know which path to go down and say, hey, we want to do X, Y, and Z. We want to do a stable coin there. We want to do this. We want to do that. Like, that's going to take some time. And because of that, the banking system is going to continue to lag. And there's going to be more air gap between, the crypto community, if you want to call it that, and the banking community. And the crypto community is getting 75% of the investment dollars right now. Right, for the last 2 years, it's roughly 75% has gone to Web3 crypto versus 25% to legacy banking and fintech. That is, I think, the most telling way for people to know where it's going, right? And because there's this regulatory gray area, I would not be at all surprised to see the lobbying and trade organizations be completely consumed by the crypto perspectives, and that becomes the dominant feature very soon. And to me, it's the Uber process or the Tesla process. Some modern company is just going to go in and fundamentally buy the legislation they want.
The other thing that you bring up with that, the kind of the way that investment is flowing right now is if you ask any brokerage firm, any bank, who is their target market right now? Millennials and Gen Xers, and I'm guaranteeing you that the vast majority of those funds are coming from their target market, right? Those are the people that they're trying to attract. But as somebody said in the chat here, they refuse to upgrade. They're dragged kicking and screaming into anything. Nothing innovative has come out of a bank. They've copied a couple of things that are popular, but that's it. And now I'm sure this year we'll see at least one or two banks, we've talked about it, that will jump into the custody business, right? Going back to the insurance firm, boy, I bet if they had the opportunity to say, oh, we're going to custody digital assets, oh, and they're insured, home run, right? But
I mean, Jimmie, let me just jump in here. I got to tell you, the number of times since I left, somebody, whether it's largest venture firms in the world, largest banks, other regulatory bodies, they've said, what is the timeline for there to be custody plus insurance? And we would also kind of like it to be done by a government, but that is not a requirement. I have heard that so many times. And Lee, in a follow-on podcast, I want to go back and forth with you on whether or not that has to be done by a nation state. I have a different opinion on that.
Love to do that.
So we have about 5 minutes left. I want to give everybody a last word. This is always fun to do this. Sultan, thanks again for coming on. But give you guys, Lee, give you kind of a last minute or two here to give us a final word.
It's like a presidential debate here. I gotta make my
I do
case.
feel like that a little bit.
Well, let me plug. So I already plugged our 4:30 event with the SEC, but have we plugged Sultan's talk? What time is that? Where is that at, Jimmie? Is that
that's going to be at 11:30. We're going. Sultan will be addressing students and faculty at the Shishiano Auditorium on Duke campus.
All right. So now you're informed. Be there. A lot of what Sultan has said regarding regulators and technology, as a former regulator, I completely agree. We have to get to a point, and I don't know how we do this, where regulators feel comfortable taking risks and aren't punished for taking risk and slipping up. And it's not just regulators; it's government in general, right? I don't know if people remember the Solyndra scandal, right, where they had received a Department of Energy loan. It was a solar panel company, and they failed, and it was a big scandal, right? So, so this is a problem with government in general. I don't know how we get there, but I saw this firsthand, and it does need to change because we're all suffering from this. And I don't think that means your regulators embrace crypto, but they need to get to a place where they feel comfortable taking risk.
Well, as a guy who really spent some time trying to do that, I got to tell you, I think there are a lot of challenges to that. I actually would say that the few examples I've seen of that going very well are far closer to things like the Department of Defense, intelligence agencies, things like that. I think the regulatory community is just culturally not wired for that. Now, there's some great iterative work going on. In fact, a couple of my former FDIC colleagues are on this right now, and there's some of the people doing some of the more interesting work there, trying to create little pockets of opportunities for innovation. So I think I still am very aggressively positive about the potential for the regulatory agencies to do it, whether we're talking about things like regulatory sandbox or public-private partnerships, or there are a variety of things that can be done there. The thing though that I really wish, and I put this in the op-ed, and I'll leave this with the last one, is like we do not have to invent all of this ourselves from scratch. If you're in the public sector, there are private sector places or other public sector opportunities, both here in the US and outside, where people have done this and figured out how to make it work. And, we need to get far more comfortable about talking far more transparently about these things. So like a discussion like this should, I wish every regulatory body in the world had these discussions, and people like us were having this interactively. And it's just a tough cultural thing. A lot of these agencies are very inwardly oriented and don't really lift their heads up to look around and see what others are doing. And now, whether it was, at FDIC, looking at what the FCA in the UK did and taking, one thing they did and kind of transforming it to fit us a little bit and then going, that's great. That's an example of that. I really hope that we all lift up and realize we're all in this together, because we have two fundamental things that we're trying to do. Number one, we're trying to create the most stable, most economically viable financial system for the next century. And number two, we want to protect the people who use it as much as possible and make sure it is fair, equitable, and equal access, right? That single sentence is not something you hear all the time. And that is I think an incentivization issue that we need to really get people focused on.
Yeah, I think it's one. Let me thank you guys both. I mean, it's always fun to do this. It's always fun to be able to have a opportunity to speak with Lee and disagree politely and hopefully respectfully. But it's always fun to do this and to hear the different ideas. I think we're all coming from really not that diametrically opposed area. I mean, we're all looking for innovation to carry us forward in the best way possible. I think we see different paths to that happening, but certainly to pull us into the future, we're going to have to change. We're going to have to adopt new technologies and things like that. The means by which we do that and the means by which this is overseen, I think that's where we differ a little bit. But I think being able to further and encourage innovation is just huge. And I think when we stop doing that, when we lose sight of that, that's when we really get into trouble. Is when we try to squash any kind of innovation or anything along those lines. But thank you guys for doing this. This has been really a lot of fun. Always a good time. I saw a lot of comments coming from the crowd. Not too many questions, but a lot of comments. And so I see that that we've at least elicited some thoughts, which is a fun thing. As Lee mentioned, he is going to have a session later today. Sultan is going to have another session here at Duke in about an hour, and then I'm going to throw one more thing out there, and this is going to be a little bit of a teaser for the fall. Do keep looking towards Duke and digital assets. Because we will be making a pretty big splash this fall, very early in the fall, probably September. But we have a couple of really big things on the horizon. So I'm not gonna give you guys any more than that. But do keep a watch on some of the things that we're going to be doing. And with that, I will say good day. Thanks everybody for joining us. It has been a lot of fun.
Thanks everyone.
Thanks, Jimmie. Thanks, Sultan.
Bye now.
Thanks everyone.